Thank you for attending this quantitative disclosure summary presentation. Today's meeting will be around 30 minutes, starting with an overview of this quarter, followed by the topic of this quarter, and then a briefing on the major risk points. Finally, we will try to address as many of your questions as possible within the schedule. In this webinar, prior to the usual presentation of the quantitative disclosures framework, we would like to give you a special presentation on the impact of the market turmoil in April 2025. All of the meeting attendees will be on mute, but if you have any questions, please let us know using the Webex Q&A function. Now, I will give an overview of the quantitative disclosures from the first quarter of 2025. JSCC keeps 74 billion yen of skin in the game, mostly from JSCC's own capital, but it also includes contributions from affiliated exchanges. On aggregate, these were equal to 75% of JSCC's shareholder equity. During this quarter, stress test breaches where the risk amount in extreme but plausible market conditions exceeded pre-funded resources were observed on 3 days for cash securities clearing service. All of the breaches were resolved on the next business day through the requirement for additional collateral. As for margin backtesting, for the past 12 months, the cover ratio was comfortably within JSCC's targets, 99.5% for IRS and CDS, and 99% for other products. There were neither liquidity stress testing breaches nor any participant defaults during this quarter. JSCC experienced no suspension of the clearing services due to system failures or for any other reasons during the past 12 months period. Now let's move on to topic of this quarter. In early April, we witnessed significant market fluctuation due to change in U.S. tariff policy. This led to ad hoc margin calls for government bonds and CDS. Fortunately, the requested margin deposits were completed on time, ensuring stability. Despite the margin backtesting breach and increased initial margin requirements, clearing operations proceeded smoothly. This was a critical factor in maintaining market integrity during this period of volatility. To give you a comprehensive overview, we provide a summary of intraday margin calls and ad hoc revisions for each clearing service in the middle of this page. Additionally, stock prices in Japan and the US, the USD-JPY exchange rate, gold prices, and the JPY interest rate are at the bottom of this page for your reference. Page 8 is about margin backtesting. Since April 3rd, when the Nikkei average dropped by 989.94 yen from the previous day, we saw a sharp increase in breaches, particularly in equities and interest rate-related services. The coverage ratios fell below target in 3 key areas: cash, index futures, and IRS, as the table below shows, while JSC's targets are 99.5% for IRS and CDS and 99% for other products. Additionally, long-term yen interest rate experienced their largest 5-day fluctuation since 2006. Even surpassing those seen during the global financial crisis in 2008. This highlights the severity of the market turmoil we faced. Considering this, on May 26, we made the decision to add a new stress event scenario for the IRS initial margin calculation and a new stress scenario for the IRS clearing fund calculation, which would normally be reviewed quarterly. Moving on to margin requirements on page 9, we observed that index future margins increased but still remained below the levels seen last August. However, margin for JGB futures increased beyond last August levels, as shown in the graphs on this page. Margin for IRS and JGB OTC was similar, due to higher volatility. In summary, the market turmoil in April 2025, driven by changes in U.S. tariff policy, led to significant market fluctuations and increased margin requirements. Despite these challenges, clearing operations proceeded smoothly, which was crucial for maintaining market stability. Now back to the PQD. Page 10 is an introduction of JSCC's service structure. The clearing services are divided into 14 categories according to the governing regulations and product features, with each maintaining its own default funds. Please note that in this presentation, some data is presented across multiple categories as the resources may be shared. Page 11 shows daily average notional value of trades cleared by asset class. You can see the steady growth of IRS after the changes in the Bank of Japan's monetary policy and the increasing demand for efficient rate risk hedging. Please note that the figures are calculated single-sided as we indicate in the explanatory notes of the PQD. Page 12 shows financial resources for a participant default, called Skin in the Game or SHIG, and contributions from relevant exchanges and PTSs. Most of the exchange contributions is from entities in the same corporate group as JSCC, namely TSE, OSE, and TOCOM. And for stress testing, the sufficiency of the financial resources for each category was tested by prorating these shared resources according to the relevant default fund amount for each category. Page 13 shows the ratio of skin in the game to JSCC's capital. The left-hand graph shows the skin in the game to be used before the mutualized default fund, or DF. And the right-hand graph shows the skin in the game to be used before the default fund plus alongside default fund of non-defaulting participants on a pro rata basis. As described below, compensation by exchange and PTS are included in SIG for ETP. Skin in the game before default fund on the left range from 16 to 88% of shareholder equity. So JSCC contributes relatively large amounts of shareholder equity to skin in the game compared to other major CCPs, which shows us our strong commitment to risk management. The ratio of skin in the game to default fund on the left range from 1 to 10% of default fund, while those on the right from 2 to 14%. Page 14 shows the required default fund, which covers any default-related losses that would be mutualized among non-defaulting participants. The graph on this page shows the ratio of skin in the game and contributions from exchange to default fund from members. On page 15, the data is listed for these graphs and the amount of potential assessment, or so-called cash call, is also provided. As stated in the footnote, the cash call for any ATD is capped at 3 times the default fund requirement, and for OTC products, it is capped at 1 time the default fund requirement. Now, let's turn to page 17. This page shows the largest value and mean value of the SLOIM, which is the stress risk amount exceeding initial margin deposited, including add-ons. Please note that due to the PFMI quantitative disclosure definitions, the default fund shows on page 18 is the value at the end of quarter, but the SLOIM on page 22 is the largest mean value during the past 12 months period. JSCC's default assumption is covered too, except for any listed commodity derivatives other than OSE petroleum, which is the largest one plus the 5 smallest firms in net assets. Among all clearing service categories, ETP index futures options had the largest volume, with a peak value of 568 billion yen. Now, turn to page 18. This page shows the number of days there was a shortfall in the stress testing of pre-funded resources and the largest shortfall. Breaches were observed on 3 days for cash securities, but all were resolved on the next business day through the requirement for additional collateral. Page 19 shows the required and excess insurance margin amounts. The dark blue is the house insurance margin requirements and dark orange shows clients. Light blue is the excess margin for house accounts and light orange shows client accounts. The required amount of OSE listed ETP, IRS, and OTC JGB was the largest at between 1.5 and 2.6 trillion yen. Looking at the breakdown between house and clients, OSE listed ETP was driven mostly by clients. IRS was evenly split between house and clients, and OTC JGB was mostly house. This trend has remained unchanged for quite a long time. Moreover, the client's excess margin held was quite large in OSE listed ETP and IRS, which has also not changed significantly. The data used for the graph on page 19 is shown on page 20 and 21. Now, page 22 shows the number of breaches in iron backtesting for the past 12 months period. The high number of breaches for ETP cash securities and ETP index futures options OSE is due to the increase caused by the market turmoil in August 2024, which is still within the 12-month scope. Also, I discussed the impact from the market turmoil in April 2025 at the beginning of this webinar. The upper chart on page 23 shows the largest breaches in the past 12 months. This test only looks at the baseline requirement without add-ons. JSCC has confirmed that these breaches would have been covered by resources such as insurance margin add-ons, excess insurance margin deposit, or skin in the game, and the whole amount of the default fund would have remained almost untouched. The lower chart of this page shows the largest breaches in the past 3 months. The upper chart on page 24 shows the quarterly largest value of variation margin or VM paid to JSCC, and the lower chart shows the largest value of insurance margin called during each quarter. For OSE listed ETP and OTC JGB, the 2024 quarter 3's increase was due to market turmoil in early August 2024. Please note that whole VM needs to be deposited and settled in cash. IM may be deposited in cash as well as various securities and other instruments, giving our participants some flexibility for funding. Now let's turn to next slide. Page 25 and 26 shows the composition of collateral used for IM deposit. On page 25, you can see the majority of ETP IM was cash, as shown in dark blue and dark orange, but some was in JGB and stocks shown in gray and yellow. Cash collateral was held at either the central bank or at selected commercial banks. The secured cash deposit at commercial banks in dark orange was held in settlement accounts of commercial banks, which are fully covered by the Japanese Deposit Insurance Scheme. For the OSE listed ETP, in the middle graph, there is a trend observed where, following the Bank of Japan's policy change, the proportion of cash deposits has decreased, and the proportion of non-cash deposits has increased in an interest-bearing environment. By the end of March 2025, the cash ratio was below 50%. On page 26, you can see a shift from cash to JGBs and the preference for commercial bank deposits over central bank deposit after the change in Bank of Japan's monetary policy. Deposit of stocks are not allowed for these OTC categories. Please note that the entire amount of cash collateral for OTC JGB was held in the central bank, and for CDS and IRS, the participants or customers may select their custodian for cash collateral, i.e. Japanese trust account or the central bank account in the name of JSCC. The secured cash deposit at commercial banks in dark orange for CDS and IRS was held in such trust account, which is legally protected from the bankruptcy of JSCC as well as the participant. Page 27 separates cash deposit into those for initial merge and default fund. We are holding a total of about 6.7 trillion yen of cash collateral across all the categories. Next, page 28 shows the custodians for this cash collateral, with almost 100% held in either the central bank account, settlement accounts covered by deposit insurance, or the trust account. Page 29 covers liquidity risk management. Please note JSCC liquidity risk appetite is covered too, but this data is presented based on cover 1 in accordance with the PQD guidance. And while JSCC separately calculates and manages default funds by category, for liquidity risk, JSCC calculates and manages it across categories. However, for OTC JGB, JSCC has established a separate liquidity framework using repo with clearing participants, because the transactions under this category involve large amounts of principal settlement. In the chart, you can see that the liquidity financial resources significantly exceed the required amount, and no breaches were reported in the liquidity stress testing. At the time of a participant default, at least the half portion of non-cash collateral could be liquidated and applied to the settlement with survivors. However, in this data, non-cash collateral is not deducted either from JSCC's payment obligation of the estimated payment or the actual payment, because to be conservative, we consider that it could be difficult to swiftly liquidate such collateral on the date of default. So we do not regard such collateral as available liquidity resources. Page 30 shows the liquidity resources for the categories other than OTC JGB. Cash is deposited at the central bank shown on the first line and secured cash deposit at commercial banks on the third line, depending on JSCC's rules. For ETP, when the clearing fund requirement exceeds 1 billion yen, half of the excess must be deposited in yen cash by cash clearing participant. Therefore, the level of cash varies depending on the default fund requirement. The unsecured cash on the fourth line shows JSC's own funds available for use as liquid financial resources following a participant default. The unsecured committed line of credit on the sixth line shows the committed liquidity available from JSCC's parent company and multiple commercial banks that have been designated as fund settlement banks, and total to more than 1.5 trillion yen. Now we will move on to Q&A. If you have any questions, please let us know using Q&A function. The questions we received are about topic of this quarter. The first question is, What measures is JSCC taking to address the coverage ratios falling below target? Our answer is JSCC has implemented additional stress event scenarios for IRS initial margin and clearing fund calculations to better manage risk in response to the coverage ratios falling below target. These measures are designed to enhance the robustness of our risk management framework. We anticipate that these adjustments, along with ongoing monitoring and market stabilization, will help restore the coverage ratios to target levels over the coming months. Regular reviews will ensure that any further necessary actions are taken promptly. Next question is, when does JSCC expect the coverage ratios to recover to target levels? Well, for equity cash and index futures, we expect the coverage ratios to recover once the bridges from the market fluctuations in August fall out of the sample, assuming the current market conditions persist. This is anticipated to occur in the coming months. As for IRS, it is likely that the coverage ratios will return to target levels after April next year. The third question received, how did the market turmoil affect the margin requirements for commodity derivatives like gold futures? The market turmoil led to an increase in margin requirements for commodity derivatives. For instance, the margin for gold futures increased by 20% from the end of March. This increase was more gradual compared to the rapid increases observed in August of the previous year. The next question we received is, what were the specific dates and reasons for the intraday initial margin calls for CDS in April 2025? Thank you for the question. Well, intraday initial margin calls for CDS occurred on April 7th and April 10th. On April 7th, the call was triggered because the iTraxx Japan spread exceeded the threshold. On April 10th, the call was triggered again as the iTraxx Japan spread exceeded the threshold. This was the first time such calls were triggered since the commencement of CDS clearing operations. Thank you for the question. Now, I would like to wrap up today's webinar. Please do not hesitate to contact us if you have any additional questions after the call. Just for your information, you can find today's material, recording of past webinar as well as the minutes of QA sessions at the same page of PQD data on our website. So please visit our website if you're interested. Thank you for your time again. We look forward to posting next webinar and speak to you soon. Thank you.